Ladies and gentlemen, I'd like to welcome you on behalf of the Institute for International Affairs at the University. Hello. Kære þakkir. This is the first time that people can't hear me, actually, I think. On behalf of the Institute of International Affairs, I'd like to welcome you all to this lecture here today. And I'd especially like to welcome our distinguished guest. With us here today is Professor Peter Katzenstein, who is one of the most influential scholars in political science in the world. And he is also a leading scholar in small state studies. He was born in Germany, but moved to the US and obtained his PhD at Harvard. And today he is professor of international studies at Cornell University. He is furthermore a fellow at the Princeton Institute of Advanced Study and the Stanford Center for Advanced Study in the Behavioral Sciences, and he has served as president of the American Political Science Association. The format of the meeting will be such that Professor Katzenstein will give a talk, and then we will have some time for discussion, questions, and answers. And I am happy to announce that I have just learned from Peter that he is not using PowerPoint. As he said, instead he is trying to use his head. That's a nice change in those times. Professor Katzenstein, the floor is yours.
Let's hope there's nothing wrong with my head today. So thank you very much for joining us this occasion. I was told not to give a lecture. I want to point this out. Everybody's saying give a lecture. I was told to not talk for more than 20 minutes because there will be somebody else who will talk for 20 minutes. I assume that will be you. But I'm very happy about this format because I come back to Iceland. I was here about 10 years ago. Not only to talk to you, but also to learn about Iceland. And I want to start off saying that this topic, I've written recently in the last 3 or 4 years on civilizations. So a very macro-cultural topic. The crisis of 2008 had a profound impact on me. And in a way which my American friends and colleagues simply hadn't understood. And they said, okay, so the Dow Jones goes down by 3,000 or 4,000 points. What's the big deal? And being born in Germany, I know that financial crises can have enormous impacts. And I don't think we have seen the major crisis. The major crisis is still coming. And my interest in Iceland is that you have seen the major crisis. You have seen what other societies will still experience. And I'm interested in learning about how you did, and in particular how you've made some very unconventional choices. That's my interest in Iceland. And I hope to write a paper comparing Iceland to Malaysia. Malaysia did very unconventional things in 1997. How and why do societies do unconventional things when the tsunami breaks over them? So these crises, I think, are a part of capitalism, which I did not fully understand, although I did write on political economy, in a way which I'm much clearer about, and I've now written 3 papers on uncertainty and risk in finance, and will spend next year teaching at the Harvard Business School. So, any American starts with a joke. By now I'm an American, I will start with a joke. So I'm going to have 3 points, and this does remind me of the joke about the rabbi who was asked to adjudicate among 3 very different arguments. So he listens to the first argument and he says, that's true. Then he listens to the second argument, and he says, that's true too. And then he listens to the third argument and is heard screaming, saying, that is true too. And so it is with my 3 points. So reading about Iceland in the last years, and I spent about a month reading, I was impressed by the importance of sagas. Sagas have a particular valence in your society, and I remember seeing the newsreel of the sagas being returned and 40,000 people, that is 10% of the population or more, milling down at the harbor as the boat pulls in. This is not a story you could tell in the United States. We don't read. But the way in which you reinvented the saga in the last 10 years to talk about your Viking capitalists, entrepreneurs, was remarkable. It was a cultural trope which apparently resonated deeply with the society, and I think you were all part of this, in order to conceal banditry on a large scale. So I think I regard Iceland, from what I've learned, the way I regard the United States or Russia. That is, the world of finance and government regulation is all about prudence and transparency, but that's just talk. That's not how it's practiced. That wasn't true in Iceland. It wasn't practiced that way. It wasn't true in the United States. It wasn't practiced that way. It wasn't true in London. The world of finance is one of predatory capitalism, and I think it's universal. Okay. Now, the one country which comes to mind when I think about Iceland is Switzerland. I was in Switzerland in November 2008, and one of the three large banks in Switzerland was belly up, UBS. And Swiss banks together, if you take their capital, the official capital, which we know exists, is 8 to 10 times the GDP. If you take what the Swiss call their quiet reserves, which nobody knows how large they are, it's going to be larger. So Iceland and Switzerland had a lot in common. Okay? And when in Switzerland, I was asked what's going to happen to Switzerland. And I said I was fairly optimistic that it would not go belly up. But the fact that it could go belly up showed the revolution in finance which we're experiencing. What happened then in the Swiss case is, of course, a smart bailout. That is, UBS was given, I think, $6 billion, and $60 billion worth of toxic assets were taken off the books by the Swiss Central Bank. And in addition, the Swiss National Bank was very active in infusing liquidity into one market only. That's where you could see the expertise, the 3-month market for interbank loan. That's what held the Swiss system together. So Switzerland could very well have had an Icelandic crash in 2008. But what it did have, apart from a depth of capital, which Iceland didn't have, was expertise in what I would call an institutional repertoire of dealing with finance, which was centuries old. So the outcome then was not surprising in the case of Iceland, that you would crash and Switzerland didn't, although the structural situation was not all that different. So my 3 takes, and this talk has nothing to do with the outline which was circulated to you, which reminds me of another joke, which is any college fundraising for money will always have a very beautiful blonde woman in a bikini on a beach, and then it says, the Bloodmobile will meet behind the library at 2 p.m. Okay? I was asked for an outline of this lecture when my head was someplace else. So I will talk about the European sovereign debt crisis. 1 part on sovereign, 1 on debt, and the 3rd one on crisis. Okay? So here comes the first point. The collapse of 2008 was in a way a prelude, if you look to the future, to the global crisis, but it was in a way also foreshadowed by the collapse of the American market by August 2007. It was not a surprise. This was different from the Asian financial crisis. The Asian financial crisis starts in Sofia in December 1996. And it then manifests itself in Asia about 5 to 6 months later. And nobody understood the connections in global capital markets. And by nobody I mean the bankers didn't, the central bankers didn't, the IMF didn't, the World Bank didn't, the politicians didn't. Nobody did. But Bulgaria's financial crisis was the canary in the mine shaft. That's when it started. Okay? And then it exploded and ended up with the Korean bailout in November 97. So these crises have their symbols and their signals. And for me, Iceland is not about the crisis of 2008. It's about the crisis of 2018 or the crisis of 228. Now, what's true about Iceland is, of course, that the adoption of the neoliberal policy paradigm and the asset bubble and the shady practices were all common. Everybody did it. And some politician was quoted, we just did what everybody else would do. I think he was telling the truth. This was the conventional wisdom. And it was conventional wisdom in Europe and in the United States, and less so in Asia because of the Asian financial crisis. They had learned their lesson. They didn't want the IMF back. So they said we'd rather accumulate enormous reserves to the tune of about $3 trillion by now, so that we are protected. The last person we want to see is an IMF banker. So in that sense, Iceland did what everybody else was doing. It was the conventional wisdom. Just think of, the great hero in the United States, Greenspan. No hero any longer, let me assure you, okay? But the guy was walking on water for 15 years. All the politicians were feeding out of his hand. Okay? He was the oracle. He was like the Delphic oracle. Although he was not a virgin and he was not high. The Delphic oracle was a virgin and she was high. Okay, so everybody was taken in and everybody was taken by surprise. Now what was different about Iceland was that the collapse of the GDP by almost 50% is more dramatic than for other societies, all other societies. But in some ways, it was the correction of illusionary money gains, paper gains. Icelandic per capita income was $70,000. Now, I assume it's around $35,000 or $40,000 per capita. Iceland is a very rich country. If you look at the income table, $35,000 to $40,000 puts you right at the top. $70,000, that difference of $35,000 was money illusion. I suffered from that money illusion myself. I looked at my portfolio of retirement stock and my mutual funds and said, wow, Katzenstein, you're rich. And then the Dow fell by 50%. And I wasn't so rich any longer. That was just illusion. These bubbles create the illusion of wealth which didn't exist. And the financiers had come up with products which were figments of their imagination. And we all believed it. Okay? So what happened here happened there in America, although it was not as dramatic. But we were all totally unprepared, intellectually and emotionally. When somebody takes something away, which even if it's only paper gain, you think is yours, it hurts. Okay? Because you have to adjust psychologically. It means that you scramble political eggs. People get angry politically. Okay? And you've seen this in American politics as you have seen it with your pots and pans here. But intellectually in the university, it was a striking illustration of the bankruptcy of modern social science. For 50 years, economists had convinced themselves that uncertainty had no longer any standing in the social sciences, that everything was risk. There was a long-standing intellectual revolution, many small steps since the late 1940s. And it results in the rational expectation theory, which says current prices price future values, which becomes the conventional wisdom in finance economics, in all business schools, in government, in the banking community. And that means that you have a dynamic equilibrium. You don't need the government to regulate. That prepared the ground. So the academy is very much implicated in what happened to society. And what's striking about it is the academy has not changed much. That is, if you look at the curriculum, business schools in the United States, it's pretty much the same. The textbooks are the same. I met with a professor here this morning. I asked, what's the textbook? He says, well, the textbook is the same textbook. It now has tagged onto a chapter on the crisis. I said, are you teaching the textbook? He says, yes, I teach the textbook, but I disagree with it in front of my students. I said, how many of your colleagues disagree? How many agree? He said, I don't know, 50-50. Which strikes me as an extremely high percentage of professors disagreeing with their textbook. Professors are very conservative. They don't want to rewrite their lectures. Okay? So 50% strikes me as very high. But in the United States, I assume 95% believe it. It has had zero impact. One of the reasons I'm going to teach at the Harvard Business School next year, not because I know anything about business, but because I got a chance to be with my granddaughters. They live in Boston. But it's right next to Bloomberg Hall. Bloomberg Hall is the old center of the Harvard Business School, refurbished with Bloomberg's money. And it's the headquarters of the finance unit at the Harvard Business School. And they run the place. And my main reason is to go there and sit in their seminars and to try to understand them. Because I'm trained in economic sociology, I can't get my head around this idea that everything is risk. I don't need my life that way. My life is normally led by saying it's risk and uncertainty, and the more important part is uncertainty, it's not risk. Right? So the academy is very much involved in this. But it wasn't the academy only. It was the academy, these finance whiz, working on Wall Street, developing the risk models, an incredibly sophisticated intellectual edifice. This is not done by economists. This is done by physicists writing these models. Okay. The models were very complicated. Nobody really understood them. For the mortgage market, I looked at it in a paper I wrote, they were off by 10,000 to 40,000% in pricing the product in the housing market. So the models themselves were not about risk assessment. The models were a social convention telling people who had to bet hundreds of millions of dollars each day that they were doing the right thing. They could get out of bed, shave, look in the mirror and saying, I'm doing the prudent thing. Even though the models stink. Okay, if you want to read a wonderful little book by one of these physicists, who's very wise, a professor at Columbia now, his name is Durman, models behaving badly. Okay, he said, that's the world of finance. They really behave badly. Okay. So these risk models didn't work, and you now find in the financial world that people, although they don't talk about it, they feel very queasy. The Financial Times reports, this is from September 26, 1912, that 70% of the institutional investors expect a tail risk event to occur within a year. Tail risk event is something like a black swan, something which isn't going to happen. 70% of the institutional investors last September thought something like that is going to happen. They thought then, I think, about the euro crisis. There's a very high sense, a pervasive sense of uncertainty in the professional investment community. And the people I know on Wall Street have taken all their money out and put it into real estate because they think the crash is still coming. They don't think we're there. What you're seeing, the celebration of the Dow at an all-time high, it's all pumped up liquidity. You've seen that movie before here in Iceland. It's just being replayed. Right? So you had also here in Iceland the debate between the optimists and the pessimists, Michigan and Portis versus Alabama and Wade. And they were important, right? So the debate existed, but the Icelandic public and the politicians didn't want to hear. They didn't want to hear the bad news. that in fact it might be all a house of cards. So the crisis implicates all of us. It's not just a crisis of, some people who make mistakes or who are venal. We're all part of this. That's what I find so interesting about my own behavior. I understand that the crash is coming, and I'm not acting on it. How schizophrenic can you be? Right? That's part of the interesting puzzle to me. And then, of course, there's the press who plays it as a morality play, right? The undeserving Icelanders first, but then it becomes the profligate Greeks, right? The Greeks, really bad, as opposed to very responsible Germans, right? Well, I just don't think it's about that at all. I don't think it's about sovereign states. So what about the solution? The solution in the American case was very easy. You print money. The big mistake of Iceland was it didn't own the world. It couldn't print money. America printed $7 trillion. Well, $7 trillion goes quite far. Okay, particularly if other people are willing to hold the money, which the Chinese are. The US Treasury market is very deep, and the Chinese know that they're losing about $100 to $300 billion a year because the value of the dollar is going to decline and the value of the renminbi is going to increase. But they think, everything considered, that's a small price to pay. Because the alternative is that the Communist Party will lose power because we cannot create the jobs for the next generation. So everything works hand in glove. Europe, the euro crisis, well, the rational thing was to print money, and that is what Mr. Draghi did. That's what saved the euro. So far only $1 trillion, there's $6 trillion to go, because the European economy is as large as the American one. So if you have a reserve currency, you can extend the game for quite a while, as the Americans, the Europeans did. Iceland didn't. Its major mistake was to behave like it could print money, but it couldn't. So since there is a financial crisis on average around the world, some crisis, financial crisis, every 18 months, we have now excellent data, courtesy of Rogoff and Reinhardt. Okay? And over the last 500 years, a major financial crisis probably every 10 years. There's only one exception in that long history. 1945 to the mid-1970s. Fixed exchange rate system. With fairly strict bank supervision. But since the mid-late 70s, we are back to our historical trend line. Now what follows is then distributional struggles about the costs and benefits of the crisis. The US did this very rationally. We consumed other people's savings. And then we invested the rest of it in foreign assets, which were growth spurring. They enhanced American growth. Herman Schwartz has written a wonderful book about this. Germany and Japan did something very different. So they didn't grow. So then Germany looks good in the last 4 or 5 years, but over the aggregate, of course, the Americans have grown much faster. So, but the distributional struggle between countries, is just under the surface. It was remarkable how well countries coordinated during the crisis, informed by 1930s experience. And it had a lot to do with Bernanke, who was a great scholar of the financial crisis of the 1930s. He saw the crisis and said, I've studied this thing, this is what we got to do. And he convinced everybody. So there was an enormous amount of not just central bank coordination, but also political cooperation, which was very impressive, which helped stabilize the system fall 2008, spring 2009. But the political capital has been used up. I don't see the political capital there next time around. Not in the United States. Maybe in Europe. I don't see it in Asia either. So it will depend whether that political capital can be regenerated for the next crisis or not. And if the next crisis is off a decade or so, maybe it can. But I think the U.S. Congress will, under no circumstances again, do what they did before. Would be political suicide. Let me then take the second step and talk about the sovereign debt crisis. Talk about debt. Now, the Icelandic figures are astronomical. Per capita, $300,000. The bank bad assets worth 3 times of GDP. These are very high figures, and they will remain high and create a debt burden for Iceland for decades to come. There's no way around it. But the European crisis, makes the American Lehman Brothers crisis look like peanuts. Lehman basically fell over $60 billion, the thing which the Swiss central bank mobilized quickly to save UBS. The European financial crisis is about $600 billion, roughly. Roughly $400 billion of bad papers owned by the French central bank, and roughly $200 billion owned by the German central bank. Or the banking system, not the central bank, sorry, the banking system. These banks hold huge amounts of bad assets from Greece, Portugal, Spain, Ireland, Italy. They did exactly what the American banks did when they bought subprime mortgages from Nevada and Florida and California. It's just here it's called a treasury bond from Portugal or Greece. But the banks, the European banks, behaved as recklessly and stupidly as the American banks. So the notion that at first, in the fall of 2008, there was sort of a sense of glee in Europe about these stupid Americans, the venal Americans. No, it's not about Americans, Europeans, it's about bankers. The risk-based models had given them the confidence to invest in things which turned out to be bad assets. And the fact that these risk-based models became so unquestioned has a lot to do with the evolution of the social sciences over the previous 60 years. So if one or two of these European countries go under, so does the German and French banking system. Now I have 3 pieces of indirect evidence for this. One is there has been no tough stress test for European banks yet. The Americans just did their 3rd stress test. The American stress tests are pretty tough, and American banks are solvent again. They've written off most of the bad assets. Europeans haven't yet. Secondly, the Draghi strategy, and he had no choice, I'm sure he did the right thing, to avert financial collapse, was to infuse huge amounts of liquidity and then to grant no interest loans to banks. It was exactly what the Japanese central bank did after 1990. In the hope that the European banks will grow out of their bad debts. This was a disappointment in Japan. After 15 years, they said, we're not growing. This will be a disappointment in Europe. Europe is growing too slowly to grow out of its bad debts. So what you have now in Europe is a big fight with a reasonable compromise. Basically, one position says, buy the debt instruments of the southern European states. That's the French position. Remonetize this. After all, we have a large central bank here. We can do this. The Bundesbank, the German position is, don't get anywhere close to this. It will end up in fascism. That was the last lesson of the 1920s. Bundesbank after 1949. Do not ever buy government treasury notes. That's not what a central bank does. The central bank does monetary policy. So you got the German and the French position, and then in between, Draghi's position, who had, of course, compromise between it. So he says, no, we'll buy some of the things, but with tough conditions, like the IMF, so that we impose a harsh deflationary dose on southern European countries, which is what Greece now suffers through, with youth unemployment in excess of 50%, and no end in sight. It's a social catastrophe. There's no other way of describing it. Iceland hasn't seen anything like this. And then finally, the third piece of evidence is that the German government is the strongest opponent of what's called Basel III. Basel III is an international agreement about the recapitalization of banks. Here is the prudent German government saying, oh yes, we like Basel III, but not in 2013 or 14, it's when the Americans and the British wanted it. We like it by 2019. Why? Because the public banks in Germany are all bankrupt. The Landesbank. And that would be a huge political crisis if that became a public knowledge to the electorate. So they're saying, well, let's buy time, and somehow we'll grow out of it. This is going to cut it very close with the statistical average of a major banking crisis every 10 years, 2019, compared to 2008, 2009. And then there are, of course, the domestic conflicts about debt. In large states, these new vulnerabilities now have led to the insight too big to fail. And it creates enormous moral hazard and, of course, encourages reckless behavior, which you see, J.P. Morgan, a few months ago, was called the London Whale, $6 billion. You will find this now because people know the banks are too large to go under. In small states, the vulnerabilities are different. And, of course, all small states, while they're small, they differ greatly. So Iceland and Ireland, two very different post-crisis scenarios. A more egalitarian one in Iceland. In Ireland, the rich got richer, the poor got poorer. Right? Protect the banks, don't protect the depositors. Two very different models. So size itself is not decisive. It's a sense of vulnerability and the institutional memory and repertoires which are enshrined in these institutions. And Baldur has written a wonderful paper in which he shows why Iceland is not Denmark, Norway, or Sweden. It's not corporatist. I think he's right. Still, Iceland is interesting to me because it's not flinching from an in-depth inquiry into what went wrong. That's quite unusual. And it's developing criminal cases against bankers. I tell you, that's, for an American, unbelievable. Okay? None of our bankers. Inside trading gets you into jail, but nothing else gets you into jail. And it worries about the moral political economy of Iceland. There is no worry about the moral political economy in the United States. So whether you end up, joining the EU in order to make up for your homegrown crony capitalist system or not, I don't know. And that party may be too late for you. It may be like neoliberalism, that you get to the EU just as it's going through another round of transformations. I have no idea. Finally, the sovereign debt crisis. I want to talk about crisis. What can international relations teach us about European integration? And I think actually it teaches us quite a lot. And I don't want to go to current international relations because I don't think it teaches us as much as the generation of the 1960s. There were three schools of thought, and they still exist today. And they had very different views on European integration. And the first one was a realist version, articulated by Stanley Hoffman, still teaching at Harvard. The second one was sociologically inclined by my thesis supervisor, Karl Deutsch. And the third one was a liberal functionalist analysis by Ernst Haas. They had very different views on European integration, and their theoretical debates anticipate very well what's happening today. The realist would look at Europe and the partial pooling of sovereignty and say, think of an artichoke. As you get closer to the heart, it's harder and harder to pull out the leaves. That is, the core of the sovereign state will remain protected. And as integration moves towards the core, there will be more and more conflict. And indeed, crisis has increased conflict. I think it shows that this perspective is true. The sociological view by Deutsch looks at mass attitudes, at the balance between supranational and nationalist sentiments, and their coincidence, because often you can be European and a nationalist at the same time. And there's ample evidence, particularly for the disjunction between elite opinions and mass opinions on the issue of European integration. Elites in Europe, now 2 generations after the horrible Second World War experience, remain pro-European. Not uniformly any longer. In the 1990s, I looked at elite surveys, 97% of the European elite were Europeanist. That's gone down, but it's still around 70%. Okay? A remarkably high proportion. Quite unrepresentative of mass publics, who in various ways are signaling through their votes and through their demonstrations that they don't see what European integration is good for them. They see it paying off for other people, but not for them. So the rise of national sentiments, yes, Deutsch is right. With European integration comes the rise of national sentiments. And then finally, and I think most importantly, the functionalist argument of Haas. Haas had the basic insight that Europe will be built up through crisis. It won't be built up through avoiding crisis. That is, integration is forced on politicians against their will. They have to be dragged into it. That is, when acting is costly, politicians will try to minimize costs. And if the choice situation is that you minimize your costs by integrating, they will integrate. Otherwise, they won't. So there's a basic misunderstanding, especially among journalists and economists, who think of integration as a cost-free proposition or a minimizing cost proposition. For a politician, it's always driven by cost. So what are the costs a politician incurs by integrating further or by stopping to integrate? And you could see this wonderfully played out for Chancellor Merkel. People think that she's dumb. She's not dumb. She is a very smart politician. Okay? She's not a visionary, but she is very smart. And the way she finished off all the male inheritance to the throne was really impressive. She kills with a stiletto. Okay? 3 of them within 18 months. And she has total control. And that to claim that she didn't understand the nature of the game is wrong. She is too smart. But she realized late in the game that if she didn't throw her support behind the euro would break up and Germany would lose more than anybody else. So she was forced against her will to make a very risky bet, picking a big fight with an important institution, the Bundesbank, looking abroad for support, and hoping to stay the course. I know where it'll play out, but her career, cautious and skillful and pretty honest. And then this wager illustrates the truth of that contestation and integration go together. So Germany and France have to compromise on the terms, and they are. Britain is facing a fundamental challenge and choice, disintegration at home. The notion of a United Kingdom no longer exists. The Welsh, the Scots, the English, Little England, all want to walk their different ways. A decomposition of the party system. That's what Cameron has to deal with the threat on the right. And of course, potential isolation from Europe. It's an incredibly difficult political situation to manage in a country which is more pro-integration than any other country on the continent. Don't forget that Britain is adopting a different legal system. And those 100,000 regulations amount to a legal revolution in Britain. And Britain's compliance record on all these regulations and directives is much better than the French and the German, not to speak of the Italians. Okay. So Britain always is covered as being Eurosceptic, etc. But the task of Europe, the task which Europe presents to Britain is always underestimated. It is a legal revolution. And the way Britain has dealt with that legal revolution, I can say, hats off. It's an extremely difficult choice for Britain. And then there are the small states. Of course they're for Europe. It's their protective belt. The the initial instinct in Iceland to look towards Europe is one which many small states have done. And now there's Greece and others being probably ruined by the harsh deflationary logic of great power politics in Europe. So, what's striking to me, let me conclude here, is that the collective ignorance in economics and the social sciences about financial markets. This is really striking. And it is, I think, because economic sociology has no standing in the social sciences. Economic sociology does not talk about risk, it talks also about uncertainty. It talks about social conventions. If you ask myself, who's the most famous economic sociologist? Soros, the hedge fund billionaire. He's written 5 books. You know, it's always a shouting match with the economists in finance economics. And he says, you guys don't understand how it works. You got the models, but the models are wrong. Here's how it works. I get an ulcer every time there's a crisis because it's nerve-wracking. How do I behave and how do the other traders behave? We look over our shoulders and say, what's the other guy doing? It's herd behavior. And if other guys are heading for the exit, most of the time I head for the exit. Okay, that's the model. And this is not quantitative modern social science. And yet it is experienced finance. And I think we need a dose of this in the social science. Economic sociology provides this. So we have a very stunted and partial view of finance, and that's a real problem. And then I think the relevance of Iceland. The relevance of Iceland for me is that it's an experiment. If there were to be a run on the dollar, this would be the first time that there would be no store of value. Gold would be the store of value, of course, but it wouldn't be enough to run the financial system in the history of capitalism. That would be rather extraordinary, and all the books would have to be rewritten. Can this happen? Yeah, it can. The Japanese bond market, which is the second largest bond market in the world, is being internationalized in the last 3 years. It'll take about 10 years. The Chinese market is opening up for hedge fund managers already. The Chinese know exactly that this is risky, but I think they will not be able to withstand it. So Asia, as the center of the accumulation of capital without financial crisis, will become the center of accumulation for capital with crisis. I don't know when the big crisis will come, but you're lucky that you had yours. The rest of us still have ours to come. Thank you.